Hey everybody, it's Paul and Seth for the Everything Money Show. Thanks for tuning in as always on YouTube. We love you guys. Thanks for watching. We appreciate the comments. Paul, you and I monitor these comments all day like children. We're just like so enamored with people commenting on the show. And I brought this up to you because we haven't talked about it in a while. Obviously, is this not the biggest company in the world? Is Amazon?
No, it's not the biggest, but it's up there.
It's getting up there
in terms of market cap.
So, folks,
Apple's still bigger. Microsoft's is bigger.
If you're joining us, if you're new to this channel, here's the story. Paul and I have been doing this for 2 years. Paul is a sort of a real estate mogul, got a lot of things going on, business owner. He's in love with stocks. Been doing
I'm an
this investment guy for a long time. I am your average Joe. Paul, we just got a comment that who's that idiot that keeps interrupting you? What
was
a moron!
You?
What's that?
Who are they talking about?
I don't know, but that was really.
I was going to ask. I was like, who are you talking about? Then I'm like, don't ask.
Did you see my comment? One of the comments we got on our channel was like, that guy that keeps interrupting the other guy, he sucks. Get rid of him. So Paul, I don't
think that was exactly it, but it was basically stop.
I just wrote back. Is it the handsome guy or the not handsome guy? Either way, they're both idiots, and you're correct. Thanks for the great comment. But regardless,
is that what you wrote?
Yeah, pretty much.
That's funny.
So I bring your comments as a viewer to Paul. You guys get insight.
Who is the not handsome guy?
That's what I'm saying. You guys, as a viewer, get insight into this man's life and how he's trading and doing on his portfolio. It's incredible. So he's been in my life for a while and absolutely changed it. I would say why we're discussing Amazon, Paul. I got some really great stock advice when I first got into the market very, very young. I got my new job and someone told me to just invest in companies that you really like. So I invested in Amazon. What are you doing with that Snickers bar? You're not you when you're hungry. That Snickers bar?
I'm good.
See that? You're not you when you're hungry.
This show is brought to you by Snickers.
It's not.
Our official sponsor. Go ahead.
Yes, they are. So, folks, I bought Amazon in around 2012. And what was it down to, Paul? Like you said, $150.
Yeah.
And then over the course of time, it went way up. And on this show, at some point, I sold 80 to 90, 100 some odd shares of Amazon when it was around $1,700. Because at that price, Paul, you were saying it was overpriced. It was a bubble ready to burst. And I sold, folks, because I had such big gains. It made up a
Not only that, it made up a big portion of your portfolio.
That's what it is. It made a vast portion
of
your portfolio. It was a lot of money.
10 times. You bought it like 150, went to 1,700. I mean,
that's a lot.
Yeah.
So we got some requests to analyze Amazon in terms of the health of the company. We know the company's incredible, Paul. You say this all the time.
Yes. And can I take over?
Please do. I'm on fire today. Go ahead.
Yeah. It's like you did a line of coke before you got here.
I did. I was sniffing glue in the parking lot. What movie? You don't know. You don't watch movies. Go ahead. Comment below if you know that movie. If you're a real movie guy, you'll know that line. Go ahead, Paul.
Hey, Chucko, that doesn't smell like mud. So Amazon, I hate to say this, it's going to sound arrogant, but also humbling.
Go ahead.
Is the only stock so far that I can definitively say without a doubt I was wrong on. Now, here's why.
Okay, tell me why.
I shorted Amazon at $280 or $800 a share back in 2015 or something like that.
No,
14, I don't remember what it was.
Paul, some of our viewers might not even know what shorting is.
We're not going to get into it now, but basically I'm betting against the stock. I thought the stock at that point was worth $50 to $80 a share. So I'm like, listen, these things can go up, but the chance of it going up 5-6 times before it collapses big time, I'm willing to bet on that one. So what happened? It started to go up and started to go up, and business started to get better, etc. Now we're sitting on Amazon. It's at $3,100 a share. I exited the short a long, long time ago. But I'm officially wrong because my current value for the stock is well above that $280 to $300 a share I started shorting it. I have Amazon worth, we'll go over it, but north of $1,000 a share, more or less, with growth potential. Do I think it's worth $3,100 a share? No. Have I been wrong before? Yes. So it was important for us to go over Amazon to show how the markets can be irrational longer than I can be solvent is a statement. Things got crazier and crazier, but at the same time, Amazon's a great business and they got better and better and better. When I shorted Amazon, they'd only made money in like 3 quarters out of 17 years or something crazy like that, right?
Yeah.
Now they're making money hand over fist,
yes, which
is great. But according to 8 Pillars, there are still issues with the company. But we should go over it because this is my only so far one that I'm willing to say I was 100% wrong on this one.
Paul mentioned the 8 pillars. We do an 8-pillar analysis. This is what Paul was doing before we even started the show. We'll go through it right now.
Now, how it differs from Tesla, because you said earlier today, well, Paul, you're wrong on Tesla. Some people would say you're wrong on Tesla. I'm not wrong on Tesla yet. Tesla is not worth $600 billion today. If in the next 5 or 10 years, it never drops big time. So that's the reason why Amazon, I was wrong on Amazon. It never corrected itself. If Amazon got from 300 to 50 and then surged up to 3,000, I'd said, no, I was right. But it didn't. It went from 300 to 260 to $1 billion. I mean, it went just insane. Yes. And that's where I'm sitting there saying, I was making a bet on a quick fall that was going to be big. Tesla, I'm still saying the same thing. Tesla has to go. Tesla is more overpriced than Amazon was when I thought Amazon was the most overpriced company in the market at that time.
Yeah.
Tesla's even crazier. Oh, let me turn my phone off.
So let's do this. If you've only ever looked at a stock because of its price, a lot of you might be saying, well, I can't afford Amazon. It's $3,200. Our goal is that you don't look at that stock price. That's the last thing you look at. We will teach you these 8 pillars on how to analyze the health of a company and see if that stock is a good bargain price, Paul. Buy low, sell high, which Correct. Not very many people do.
When people hear buy low, sell high, they think buy low dollar amount, sell high dollar amount.
Yes.
I mean buy low in terms of the price relative to the value and sell when the price is higher than the value or at value.
Let's get after it. What is the market cap of Amazon? I see it's $1.7 billion, or is that
1.6 trillion?
Trillion. 1.6 trillion. Oh boy.
The PE ratio, 95.
This is pillar number 1. PE ratio. We want this less than 20, Paul. Don't interrupt me. 20, Paul. Go ahead.
Keep in mind, when I started shorting Amazon, I think the PE ratio was like 400 or something like that. 500. It was insane. Or it didn't have a PE ratio because they hadn't made money in a year. So this is a big number. Big X. Profit margin. 6.6%.
That's good as well. Pillar number 2.
This is actually high for Amazon.
For retail?
They were usually in the 3 to 4% range. And this last few quarters, they've had a massive surge. Here's the way I'll put it.
Go on.
In the first quarter of this year, Amazon online sales were 11% of all retail sales. Then they jumped to 16% the second quarter. And Amazon owns half of the online ordering market. So if you're selling something online, you're not on Amazon. You're basically fighting like this incredibly amazing company that gets people in there to buy stuff. Everybody goes to Amazon to buy stuff. I love it. That was the other thing. People are like, but Paul, you love Amazon. I'm like, I can love the company,
yes.
Hate the stock. I love Amazon as a company, hate the stock.
Same thing as Tesla as well. I mean, I drive a Tesla, but I sold all my shares. So.
Yeah, and it's crazy. So right now we have 2 X's.
We went pillar number 2, profit margin above 10%. That's where Paul likes it. Let's go to pillar number 3, which is revenue growth over the past 5 years, baby.
Okay.
I'm sure this is absurd, right, Paul?
Now, it is absurd. 107 to 280. Check mark. They made a few acquisitions along the way, but these are genuine. But here's the big thing, guys. Let's look at their last 12 months. Their last 12 months, $350 billion. They went from $280 billion last year in the whole year, and now in the last 12 months, they've done $350 billion in revenue. This whole working on, people are going, I believe this is a permanent plateau of revenue. I don't think people are going to go, it's going to be harder for people to go back to the stores than buying on Amazon. Mo just texted me yesterday. Trader Mo texted me yesterday. He said he ordered 2 things yesterday at noon. It was at his house by 2 o'clock. By 2 p.m.
Same day?
Same day. Same day. Same meal. Like he probably made a sandwich. And he was probably like, oh, the thing's here. It's crazy.
I can't believe it.
They did a great job with that.
Pillar number 4 is profit growth over the past 5 years, Paul. I'm sure this is absurd
insane.
As well.
This is really absurd. 596 million to 11.6 billion. The last 12 months, they've done 17.5 billion in profit.
Now, if this video gets 17 billion likes, Paul will do the next video completely butt naked. So make sure you're smashing that thumbs up. And as always, subscribe. Just a little tickle that thumbs up. We'll really appreciate it. Thank you guys for the effort.
Pillar number 5, shares outstanding.
We want this going down, Paul. You know
this is an X. It is going up.
Ain't nobody got time for that.
Now, I think a big reason for this is everybody loves Amazon shares so much, they're probably using their shares to buy companies. When everybody wants the shares, they're probably like, they have to make an acquisition. They're looking at going, great, we'll just dilute our other investors. Fine by us.
So they're basically saying, we know this stock price is high. Let's capitalize on it and sell off some shares.
Which I actually like this strategy.
Really?
Yeah, I like that. When your price is when your stock is overpriced, you should use your shares to buy other companies. It's not good for investors, but from a standpoint of the company, I actually don't mind it. I want to hear the reasons why I shouldn't like that, but I like it so far.
Pillar number 6 is current assets greater than current liabilities.
113 billion in current assets, 101 in current liabilities, cash on hand versus debt that's due soon. They have the margin. Check mark there.
All right. The one that you love the most is pillar number 7, free cash flow growth. This is cash from operations minus capital expenditures, Paul.
Okay. So it's 6.6 billion to 22 billion. So check mark there.
Good Lord.
Uncle Seth, are you ready to start doing some math?
Just give me the 3 middle ones.
10, 6.4, and 17.
17 divided by 5. So the free cash flow average over the past 5 years is $12.4 billion.
Okay. Now, you got to ask yourself,
12.4.
$12.4 billion. What multiple do you want to pay for that cash flow?
Well, this is a huge question, Paul. People say,
Yes.
why does he multiply by 20, sometimes by 15? So this is our pillar.
Sometimes by 25.
This is our pillar number 8.
The
It's
faster
free cash flow, price to free cash flow. Explain that, Paul.
The faster the company is growing, and the more skewed it is up, the more recent higher. Look at this. It's 22 billion recent here and 6.6 here. So if you're applying an average that's low to a very middle number, you're already discounting the current free cash flow. And by the way, let's do this. I got to erase this. The trailing 12 months. In the trailing 12 months, in the last 12 months, they've done 25 billion in free cash flow.
So calling the average at 12 is a little misleading, you would say, considering 2 years ago
so
it was 6.
Let's just look at the last 12 months. Let's call it 25 billion.
Oh boy.
20 times free cash flow. That's $500 billion.
Oh my Lord, we're at 1.6 trillion, Paul.
1.6 trillion. It needs to drop by 65%. So you're looking at $1,000 a share.
Now let me slow you down real quick because this is where our viewers really get you. These two numbers, 500 bill versus 1.6 trillion. Explain it one more time for me.
So 500 billion is 20 times the last year's free cash flow, and 1.6 trillion is the market cap. But we want to pay 500 billion. So in order to get from 1.6 to 500, it's got to drop by about 2/3, about $1,000 a share. But I have my trusty Excel model, which I'm going to pull up here and go through because this is important for a company like Amazon that's growing so much.
Pause
I
for a
created
minute.
this Excel model.
Go ahead, Paul.
What I did was create this Excel model. And what it does is it allows me to input my ticker. It allows me to look at the annualized revenue growth of the last 5 years, annualized income growth of the last 5 years, all my other growths, average profit margin. Look at the last 5 years, average profit margin is only 3.6%. So recently they've been doing a lot better. And then model out the next 5 years in cash flow, in revenue, profit, apply a net present value. So what I'm doing here also is on this side, I can discount revenue growth. It's not going to grow for 30% a year forever. You got to discount that. So I do 50, 75, and 100. I think here, 30% a year, if they did $480 billion, in 5 years, that would be, we have to do the math here, but it's something like 900, it's going to basically double. It's going to go to $1 trillion. Is that possible? Yes. Is it probable? I have a hard time believing they're going to be able to grow at 30% a year for the next 5 years.
These are some of the assumptions you make when investing, right?
Yes. Whenever you invest, you have to make assumptions. What's the future going to look like? You don't ever really know. Is 15% a year more likely? That sounds about right. So let's say we cut that in half. I'm just going to put all these, I'm just going to sit there and say I'm cutting it all in half. Net present value. This is telling me how much do I want to discount all those future because an investment, all an investment is the present value of future cash flows. If I'm going to give you $1 for the next 5 years, if I told you to pay me $5 say for it, why would you? First off, this is uncertain, right? And you want to make a return on your money. Why would I give $5 today to get $5 in the next 5 years? I want to make some sort of return. So the discount rate is how much, let's say it's 10%. This might be $3.4. And I'm like, okay, I pay 3.4 today, and I want a 10%. I don't know what the exact number is. So don't quote me on this and send me messages going, you're a moron, it's 3, whatever the number is.
We'll get those anyway, Paul. But go on.
Exactly. So that's what we're trying to do here. Because a company overall is going to be a present value of all its future cash flows. So I'm going to discount for what it's worth today, 10%. Because overall, the market should make about 10% a year in S&P. So I'm going to discount it exactly. If I want to match, what do I think the company's worth today? What would I have to pay for it today for the next 5 years to make 10% a year? Now, profit margin. Now, here's the deal, guys. This profit margin might be low. I don't know because the big surge in profit margin lately at 6.5%, it's probably because of volume. Like they did so much volume with the same fixed overhead. That's why they made so much money. So is this kind of low? Maybe. Is it 6.5? I don't know. I can actually increase this profit margin. Let's say I say, you know what? Their profit margin is going to go up 115% over the next whatever years. Now, here's the current price. It runs the model for me.
3,200. And you want to pay?
This model is telling me if I paid $7.77 a share and all these assumptions came true, based on all of history here, I will make about 10% per year.
$777?
Correct.
So so the people who are buying today at 32, what are they doing?
They're assuming So then I have to sit there and say, okay, what are their assumptions? Let's go look at what their assumptions have to be on the left here to make that happen. Let's keep revenue growth at 100%, at 30% a year let's put it this way. If their revenue growth stays at 30% a year for 5 years, the company's currently worth $13.30 to them. And it's $32.37. So what does that have to be then? Let's go to 150%. Let's go to almost 50% growth per year.
50%?
50% growth per year. Look at the stock price. The stock you have to pay. That means the stock is worth 20. So guys, when you're paying $3,200
today for this
today, you're basically assuming that they're going to grow, that their growth rate in revenue is going to be 1.75 times this. So that means roughly what's 75% of 30? 22. It's like 53% a year, roughly. Is that right? I don't know. You're assuming for the next 5 years, they're going to grow their revenue at 53% a year. Guys, they did in the last 12 months, $480 billion. So you're now assuming that next year, they're going to do $720 billion. The year after that, they're going to do $1.08 trillion. The year after that, they're going to do $1.6 trillion. You see what I'm saying? Guys, is this realistic?
Paul, what other people are probably saying is all I really need to do is have the stock price go up a little bit and I'll
guess
make
what?
money. Go ahead, tell me.
Greater fool theory, and it's worked in the past, so there'll be things that it'll stop working now. This has worked for the last 5 or 10 years. So in everybody's mind, it's like, oh, well, it's worked, so why do I have to change? I look at everything as an investment. An investment to me is the present value of future cash flows and the assumptions I'm making to get those values. Now, if this profit margin goes up a ton, can they get a lower revenue growth? Absolutely. But look, let's do it this way. Let's say their profit margin doubles. And they keep the same revenue growth. It's still not worth today. So if their profit margin goes from 3.6 to 7.2. FYI, they've never had 7.2% profit margin in their entire history. The most recent quarters that were massive volume on the same overhead didn't even get 7.2%. I'm assuming that their revenue growth stays at 30% a year for the next 5 years. It's still not worth today's price.
$2,600 bucks.
$2,663. Call it $2,650. Again, could I be wrong? Absolutely. I was already wrong on Amazon. But it's easier to go from $50 billion in revenue to $500 billion than it is to go from $480 billion to whatever trillions it needs to be. And that's all investing is analyzing the present value of all these assumptions. Now, for those of you out there saying, it's a growth company, doesn't matter, fundamentals don't matter, with the second you say that, you're saying that fundamentals do matter, because all you're doing when you say it's a growth company is you're sitting there saying these growth numbers are going to continue in the future and therefore drive the justification for this price. Okay, but you do care about fundamentals then. So again, could I be wrong? I will be wrong, but I have a hard time believing it's going to be for the reasons that most people think. You have to make these major assumptions. Every investment that's ever been pitched to me, it's never, ever, ever been pitched to me where they said it's a bad investment. It's all based on your assumptions. Garbage in, garbage out. It's especially common with real estate. People come to me and say, hey, I analyzed all the numbers. Well, show me the analysis. And all they did was just show me what the broker gave them. I'm like, that's not analyzing. Analyzing is going into the numbers and saying, are these inputs reasonable? Are all of these inputs reasonable? Are these inputs reasonable? You have to do a range of, that's why I do a range. I do 50%, I usually, for the revenue side, I do 50%, 75%. Net present value, I want a discount, I do 15. Profit margin, I tend to keep the same because their profit margins just stay about equal usually. It all depends on the company, but for something like Amazon, I look at it saying it's between 530 and 1,000. So 775 sounds about right. That's my interpretation of it. Will this number go higher? Absolutely. As they do better and better, if they beat these projections, this number will go higher and higher. And it's also based on only 5 years. It's also only based on 5 years. If I want to do a longer analysis, it'll probably drive this number up. So that's why I said it's worth about 1,000. Okay, that seems about right. But I'm not dying to buy it for 1,000. I might be interested in 1,000 and do more research, but I'd sit there and say, and maybe I would buy it, but everything is based on your analysis and your inputs and your assumptions.
If you made it this far into the show, hopefully you can realize that Paul is really teaching and educating the math behind a company. Unfortunately, a lot of our competitors who have hundreds of thousands of more subscribers than us are basically telling you that if Amazon's going in this direction up, actually it's this direction from the viewer. If it's going this way, just keep buying. It's always going to do that. And of course, Paul is showing that the math may not be very well the case. So before you spend your hard-earned money on an Amazon stock, you might want to look into it. If you're interested in what Paul's teaching you, a more disciplined approach to investing, join our Patreon. Damn it, it's I said damn it, Paul. We might get in trouble. We're trying not to curse more, but on our Patreon, you will get full Paul and Seth cursing videos. Isn't that right, Paul?
Yes, you'll get all the videos, and if you pay for the highest level, which is the best level, you get full access to me and Trader Mo literally every single day, day in, day out, asking us direct questions. We talk about all of our investment ideas in that chat. We do not deviate. Like even when we talk in person about something, we go back in the chat and discuss it.
This is patreon.com/everythingmoney. As always, thanks, guys. Paul, so at the moment, obviously, Amazon is a big no-buy for you.
Yeah, but it's an exciting company, and it's just like Microsoft back 20 years ago. 20 years ago, I didn't want to buy Microsoft stock. 2012, I was the biggest lover of Microsoft stock. There'll be a time when I'm a big buyer of Amazon, and everybody out there is going to be like, no, they don't make that. Their revenue now has dropped to 7%. They suck. Okay, I like it now. Mm-hmm. I like the boring companies. Because the boring companies are overlooked.
Make sure you guys are smashing that like button, and as always, subscribe. We love you. Thanks for joining us. See you guys.